You check your phone. There's a message you didn't ask for. Need cash fast? No questions asked? You scroll past it, but it's not random. It never is. That message appeared because something about your life triggered it. A location, a purchase, a pause in spending. It's not trying to help you. It's tracking you. And worse, it's targeting you. Because in the world you live in, your struggle isn't a tragedy. It's a market. Your missed payment, your anxiety at the checkout, your silence when the phone rings, each one is a signal. And someone, somewhere, is watching those signals light up like a dashboard of human distress and smiling, because they know exactly how to profit when you're at your lowest. Not just once, but systematically. This isn't a glitch. It's not some rare abuse. It's the model. A perfectly legal, highly optimized machine designed to monetize misery. And the deeper we go, the more it reveals just how much pain has been productivized. There's a term used quietly in certain boardrooms: underserved markets. It sounds noble, like someone's finally trying to help. But what it often means is that someone found a pocket of people desperate enough to say yes to anything. No credit, no savings, no problem. Because in the economy of struggle, that's not a red flag, it's an invitation. Take payday loans. They offer a few $100s, fast, no questions asked. What they don't mention, unless you read the microscopic text, is that the annual interest rate can hit 400%. 400. In other words, you don't borrow money, you lease your future. In 2023 alone, Americans paid over $9 billion in fees to payday lenders. That's not the loan, that's just the cost of being in crisis. And here's where it gets darker. The business isn't built for repayment. It's built for rollover, for you to come back week after week, stuck in a loop. Not a customer, a captive. But that's just one corner of this system. Let's talk about private health care, where the real money isn't in cures, but in chronic. A healthy person pays once, a struggling one pays forever. Insulin prices in the U.S. tripled between 2002 and 2013, not because it costs more to produce, but because it can, because patients don't have leverage when they're desperate. Now layer that with mental health apps, many funded by venture capital. They don't want you to feel better tomorrow. They want you to log in every day, because recurring sadness means recurring revenue. And then there's the prison industry. In states with private prisons, contracts often include occupancy guarantees, meaning taxpayers pay penalties if too few people are incarcerated. Yes, emptier prisons are bad for business. So the pressure to criminalize poverty, loitering, unpaid fines, minor drug offenses, becomes part of the profit model. Even eviction has become an industry. Large landlords use data analytics to identify which tenants are most likely to struggle and file evictions strategically, not to remove them, but to extract late fees. Your pain isn't invisible. It's just been repackaged as predictable cash flow. And here's the twist no one tells you. These companies don't need you to succeed. In fact, they prefer if you don't, because struggle is sticky, and sticky means retention. And in every investor deck, one metric rules them all: lifetime customer value. Which raises a question most people never dare to ask. What if you getting better is bad for business? To answer that, we need to look deeper, not just at what's being sold, but at how you're being tracked, measured, and targeted. Because this system doesn't wait for you to struggle, it anticipates it. Before you even realize you're slipping, the system already knows. Your phone battery's dying more often? Your grocery purchases just shifted from brands to generics. You paused your gym membership. You canceled Netflix. Each choice feels personal, but in the data economy, it's just signal. Because today, pain is no longer invisible. It's measurable, trackable, actionable. Welcome to the era of predictive poverty. There are companies whose entire business is to scan your digital footprint for signs of distress. They track late-night browsing, location changes, keyword searches. Did you look up debt relief? Did you visit a pawn shop? That's enough to flag you as a target for high-interest financial products. One firm, for example, claims it can predict financial instability 90 days before it happens, not by asking you anything, but by watching everything. And once you're flagged, the algorithm goes to work. You start receiving solutions, loan offers, subscriptions, promotions, not designed to help, but to convert your instability into engagement. Because in this system, the worst performing humans are often the best performing users. Let's go deeper. In the world of behavioral finance, there's a concept called scarcity mindset. When people are under pressure, financially, emotionally, their ability to plan long-term collapses. They choose the quick fix. They default to short-term rewards. Advertisers love scarcity mindset. It means you'll click faster, spend impulsively, accept worse terms. You're not being irrational. You're being predictable under pressure. And to them, predictable is gold. Now combine this with credit scoring systems. You might think they exist to assess risk, but what they also do is create permission for predatory pricing. If your score is low, lenders can charge you more, legally. Your hardship becomes their markup. And if you think opting out is possible, it's not. One major alternative data broker collects over 10,000 data points per person, including your rent payments, social media behavior, even what time of day you tend to shop. Their clients? Banks, retailers, insurance firms. They don't need your consent. They already have your pattern. And here's where it turns systemic. Investors now use poverty data to bet on entire sectors. If late payments spike in a region, hedge funds might short retail stocks in that area. If opioid prescriptions rise, they might buy into rehab chains. If unemployment ticks up, payday lenders see growth potential. It's not just that your struggle is monetized, it's financialized, packaged, sold, and traded. There's a dashboard somewhere where your desperation is just a green light. This isn't about evil corporations, it's about engineered behavior. Because if you can track someone's pain, you can time the offer. You can maximize the squeeze. You can extract, not once, but over and over with surgical precision. And the more we train the system, the smarter it gets at finding the next you. But there's one more layer to this. Because this isn't just capitalism watching misery. Sometimes it creates it. To see how, we have to follow the incentives. And that means stepping into the one place where suffering always equals profit. Crisis. It always starts the same way. A sudden spike in fear, a disruption, a downturn, a virus. And while the public scrambles, the system calculates. Every crisis is a reset, not for you, for capital. Because in the economy of struggle, collapse isn't failure, it's opportunity. Let's rewind to March 2020. As lockdowns began, markets crashed. Millions lost their jobs in a single month. Fear was everywhere. But behind closed doors, hedge funds were repositioning fast. In just 30 days, U.S. billionaires increased their wealth by $434 billion. How? They weren't guessing. They were betting, strategically, on misery. Retail was collapsing? Short it. Tech dependency rising? Go long on Zoom and delivery platforms. Stimulus checks landing? Buy into discount chains and payday lenders. Every data point became a signal. Every signal, a profit stream. But crisis capitalism isn't just about reaction. It's about design. In 2008, the financial system imploded under the weight of its own greed. Subprime mortgages, toxic derivatives, reckless lending. It all came crashing down. Millions were evicted. Pension funds were wiped. But the institutions that caused it, they were rescued. Not because they deserved it, but because the system couldn't function without them. The government injected over $700 billion into failing banks, and in the same breath, let homeowners drown. Wall Street took the bailout, and then used it to buy back their own stock. The suffering wasn't a bug, it was fuel. And it gets even colder. Some firms now specialize in distressed assets, which sounds boring until you realize what that means. They wait for people, businesses, or even entire countries to hit rock bottom. Then they swoop in, buying debt, property, influence for pennies on the dollar. And when the recovery comes, they own the upside because they bought the downside. During the Greek debt crisis, for example, vulture funds bought government bonds at steep discounts, then sued Greece for full value in foreign courts. They didn't help rebuild the economy. They just extracted profit from collapse. It's not illegal. It's just optimized. And here's the uncomfortable truth. The worse the world gets, the easier it is to predict what comes next. More foreclosures? Private equity is already there, buying homes in bulk. More medical bankruptcies? Insurers will raise premiums, not to cover losses, but to anticipate them. More instability? Defense stocks rise. And as climate disasters increase, entire funds are now being built around resilience assets, not to prevent suffering, but to benefit from it. Because in this system, every pain point becomes a price point. But there's a question we haven't asked yet. If suffering is profitable, what stops the system from making it permanent? To answer that, we need to look at how the rules are written, and, more importantly, who writes them. By now, you've seen the pattern. Suffering isn't just monetized, it's scaled. But there's a reason this machine runs so smoothly. It's not just strategy, it's law. Because every trap needs a cage, and in this system, the bars are legal. Start with payday lending. You might assume charging 400% interest is illegal. In many places, it was, until lobbyists showed up. Over the past 2 decades, short-term lenders have poured over $100 million into campaigns and political influence, shaping legislation state by state. They don't fight to remove regulations, they fight to rewrite them. In some states, they lobbied to redefine loans as financial services. In others, they capped loan sizes just above the average emergency cost, maximizing desperation, not relief. And when regulators tried to step in, they sued. Or they waited, because they knew one thing most people forget. Pain has no lobby, but profit always does. Now shift to bankruptcy laws. Once, declaring bankruptcy was a way out, a painful reset, but a second chance. But in 2005, a major reform changed the game. It made it harder to discharge personal debt and easier for banks to collect forever. The bill was heavily backed by the credit industry and written, in part, by their legal teams. Today, even if your income collapses, certain debts follow you for life. You don't just owe money, you owe structure. And if you default, well, there's a product for that too. Collection agencies buy debts for cents on the dollar, then sue in bulk. Tens of thousands of lawsuits filed every week, many against people who don't even know they're being sued. Miss the court date? You lose by default. Your wages get garnished, your account frozen, your credit destroyed. All perfectly legal. And while that happens, corporations use a different playbook entirely. They use something called strategic bankruptcy. They restructure, they shed liabilities. Sometimes they even create shell entities just to absorb lawsuits. Johnson & Johnson did this with talc-related cancer claims. They moved billions into a new company, then declared that company bankrupt. Victims got silence. Shareholders got protection. You try to file bankruptcy, you lose your home. They do it. They keep the brand. This isn't corruption. It's coordination. Because the laws weren't broken, they were designed. Designed to create a two-tier economy, one where the wealthy are shielded by legal fortresses, and the rest are trapped in contracts they'll never fully understand. But perhaps the most dangerous part isn't the law itself, it's the illusion it creates. The illusion that your failure is personal, that your poverty is a result of bad choices, that if you just worked harder, managed better, planned smarter, you'd escape. That's the final reinforcement, because once you believe that, you won't look at the system. You'll only blame yourself. But what if it was never meant to let you escape? To understand that, we have to go deeper than debt. We need to examine the logic behind the machine, the cold business reason why your struggle is never seen as a problem, but as a subscription. Most business models are built around growth, but some are built around dependence. And in the economy of struggle, retention is everything. If you solve a customer's problem, they leave. But if you keep them almost afloat, just enough to keep paying, they stay. That's why the most profitable customers are often the most financially unstable. They overdraft more, they pay more in fees, they miss more payments, and every miss is a charge. You're not a client, you're a stream of micro penalties. And the system's goal isn't to trap everyone, just enough to keep the cycle going. Some never fall in, some fall and get out, but the majority, they stay in orbit, too broke to escape, too afraid to stop. Even in healthcare, this logic applies. Many insurance plans don't reward prevention, they reward ongoing treatment, because a patient who recovers stops generating revenue. And that mindset bleeds into everything. Financial apps that gamify debt but never erase it, subscription models for essentials, food, medicine, even housing, all optimized to feel convenient while locking you into a structure you didn't design. And when someone does escape, they're no longer valuable, because the sick system doesn't just tolerate struggle, it requires it. But here's the quiet final twist. You were never broken. The system just needed you to believe you were. Because the moment you realize the trap isn't personal, is the moment it starts to lose power. And that is the one thing it can't afford. If you've made it this far, you already see what most never will. Not just the system, but the design behind it, the incentives, the silence. the smile behind the screen every time you struggle. Because this wasn't about a single industry. It was about a mindset, a model that thrives when you don't. And now that you've seen it, you can't unsee it. If this kind of truth matters to you, the kind they'd rather keep buried, then help us expose more. Leave a like, subscribe, and bring someone with you into the next investigation. Because the more of us who ask, how deep does it go, the closer we get to a world where the answer no longer needs to be whispered,